New York City's pensions are boosting allocations to investments like areas in private equity and alternative investing. Wall Street Week host David Westin spoke with Stephen Meier, the New York City retirement system CIO, about the changes.
From a private markets perspective, we're increasing our exposure to private assets anywhere between 6.5% and 7% on average across the funds. And that means over the course of time, and we'll go through a pacing plan process for deployment so we get vintage year diversification. But we're looking to increase our exposure to private assets by between $15 and $20 billion. We're about $60 billion now, so that'll take us between $75 and $80 billion once it's fully deployed over time. So we actually think those are real key performance drivers for the funds. We look at those as bringing interesting diversification away from public markets. Again, through our legislation, we had a constrained opportunity set previously. We now have a little bit more flexibility to generate those returns that our portfolios need to pay beneficiaries.
I noticed you say private assets, so it's not just private equity, it's also private credit and other things. How does that break down roughly? Do you have a breakdown within the category?
Sure. So private equity allocations across our funds are anywhere between 10 and 12% with the new allocations. Alternative credit, about 6 to 7%. Infrastructure, about 5 to 7%. Core and non-core real estate hasn't had a significant change. It's up at the margin a little bit. And again, 2 of the 5 pension plans that we manage for the city of New York for police and fire actually invest in hedge funds. So they're about flat there.
Where is the money coming out of that otherwise would have gotten allocated to?
That's a smart question, David. It's coming out of, for the most part, public equities. U.S. and non-U.S. So we've actually, because of the legislation that constrained our opportunity set, we had a slight overweight to equities at anywhere between 43 and 46%. So that's coming down. I'd say in fixed income, given the backup in base rates and the widening of some credit spreads, that's been pretty much maintained, maybe off a little bit, but anywhere between 6 and 7% reductions over the entire $265 billion portfolio in equity exposure over time.
Steve, I'm wondering what effect the increased interest rates have had on your investment decisions. When you say a 7% target rate you have, you can get 5% in fixed income these days, right? It was that you couldn't get anything hardly. Now you get 5%. That's getting pretty close to 7. Do you allocate more toward fixed income?
A little bit. We've shifted around a little bit. One of the things that we've done in our portfolios as a result of the strategic asset allocation review is we actually eliminated TIPS. TIPS actually performed below our expectations in 2022 and 2023. They barely outperformed nominals, and they tend to respond more to long-term inflation expectations at 10 years, which really means it doesn't work as a short-term hedge. But in terms of our allocations and our holdings of fixed income securities, yeah, you're absolutely right. The base rates help power the yield, provides a nice balance for the portfolio.
Lastly, Steve, one of the things that we've talked about before is so-called ESG, environmental social governance, and people don't like that term anymore, but whatever you want to call it. It's been controversial. I think you even had some litigation at one point over it. Where are you right now on that question about how you take into account some of those risks, as it were, in investments as you make your investments?
So, David, we've never invested in any products that have the ESG moniker or have a label of ESG. However, every investment we make, we look through an ESG lens, meaning we look for environmental, social, and governance factors in our portfolio companies that will drive long-term value creation and help mitigate risks such as litigation risk, regulatory risk, and reputational risk. And we think that the funds, the companies that we invest in our underlying funds that adhere to ESG standards will have better long-term results and again, be better investments for us, again, over a longer period of time. But we look at everything through an ESG lens, but we do not invest in anything with an ESG moniker. It's not a social program. We're fiduciaries, and we invest solely to generate returns for our pension beneficiaries and participants.
So you take into account, in order to get the return, do you have enough of an historical experience now to know whether, on average, over time, you actually can get better returns by taking into account some of those risks?
Oh, I definitely think so. I think the companies that have more of a long-term perspective, that look at the potential impact of their externalities, that consider the safety and well-being of their workforce, that look at the impact on climate associated with their operations, are going to be better positioned to reduce exposure to reputational damage, litigation, regulatory risk, and can again drive long-term value creation over time. So we actually believe we've demonstrated very effectively that again, looking through that lens is very beneficial to the portfolios.